From the morning reading, private equity and venture capital investors are unloading shares to the public at a record pace. In the past, when we've seen these investors offload shares in so many companies, public stocks have struggled in the months ahead. Also, for the first time in history, the SPY has suffered 10 red candles in a row, created when the fund closes below its opening price for the day. Using the futures, such a streak was matched only by the July 30th, 1999 stretch, after which the S&P lost ground for another 7 days before bottoming and making up the losses. Using other funds, there have been 10-day streaks in the diamonds, once July 1st, 2010, after which it rebounded 4.9% the next week. IWM once March 29, 2005, after which it rallied 1.6% during the next week, and the QQQ once, same as the diamonds. Scanning all stocks in the S&P, there are 776 such streaks, which led to 1 week rallies 57% of the time, averaging 1%. This just barely misses a test for positive statistical significance. So obviously, pretty pronounced weakness that has been shown of recent. Let's take a look at the chart and see just what that looked like. There you go. 10 red candles in a row. Not a very good sign when every single day it opens, closes lower than it's open. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:16 Central Time, and I am recording this in preparation for the market day of July the 6th, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So we are looking at the charts here. The SPY weakness one day after another. And it's not just weakness in that we've actually got a short-term downtrend with something of a bounce, but also that the bulls have not controlled any of these individual days. Every single one of these days has a close lower than the open. And some of the other markets, let's see here. See, the Russell also has broken down. NASDAQ very similar. Dow Jones actually had some up days in the midst of all that, but obviously the exact same trend in terms of the overall action. And of course, at the same time, let's take a quick look at bonds. Bonds has been more of a range during this period. Obviously, this is against the backdrop of Greece. And of course, last night, when the markets opened, they were down about 20, should say maybe 30 about the time of the open. But since then, things have changed quite a bit. So we went from down 20 at the open to down about 13 at this point. So actually quite a bit of recovery during the night. Down about 0.5% or more in all four broad market indices. In the NASDAQ and Dow, down about 0.75%. Crude oil, look at this. Crude oil down almost 5%. Big down move on crude oil. Euro down about almost 0.5%. Bonds up 1.4%, and gold essentially scratched. So when you look at the safe havens, you did have a move in bonds, but gold really has done nothing. So pretty interesting there. In terms of overseas action, you have with China up 2.4%, but Hong Kong down over 3%, Japan down over 2%, Germany down about 1.5%, and the United Kingdom down about 0.5%. You see the differential there with the exposure on the euro. In terms of macroeconomic reports for today, obviously we got the ISM non-manufacturing PMI for the United States. The main thing, though, I should say, we'll take a look at these, but it's all about Greece this week. And as those headlines roll back and forth, it's going to be about Greece. There won't be a lot probably settled today. There'll be a number of meetings that'll start tonight, probably after the market closes, as these ministers gather. But bottom line is that tomorrow we've got trade balance, but that's not really going to matter anywhere near as much as it might on a regular week. It's going to be all Greece all the time until that situation finds some sort of balance. Remember, the market hates uncertainty, and there's a lot of uncertainty right now with respect to what's going on in Europe, with specifically Greece. Also, I should mention uncertainty with respect to China. They've changed the rules over there, and the brokerages are going to have a lot more control over margin, and that could sometime in the future also play in for significantly more volatility. In terms of our volatility trends, our short-term VIX right now is right at an 18. You see the skews below 125, so not really calling for anything monstrous in a downturn. IV percentiles 43, 45, 39, 61. Really nothing to get excited about there. In terms of standard deviation moves, we did have a standard deviation move put in by the Russell on Thursday, so kind of keep that in mind. But really, this is, if anything, a little bit below normal. We normally have about 4 days with standard deviation moves in a 2-week period. Now, obviously, we had the big one there with 3 standard deviation moves being put in by 2 of the markets, and over 2 in the other 2 markets. So that continues to be looming out there, and obviously, we're going to see this Greece situation. It's going to have to play out. Now, in terms of our daily report, our market trend intermediate term phase opinion still remains as phase 5, the break of diagonal and horizontal support. And while we have had some move back to the range, we've not come back into the prior range. In fact, if anything, that prior range seems to be acting as resistance now. So this is this is pretty dangerous area, and obviously with the Greek Open that we have today, we'll be opening down. And remember, Friday the futures market was actually open for a couple hours, and I think it was down about 4, and then from there we're down about another 12 or 13. So depending on where the market opens and what the public does with the cash open, if we stay down in this area below this prior range, that can become pretty stiff resistance above this current price action, and it brings into question whether we might come down here to 200 or something like that in the days to come. So pretty significant resistance there. In terms of our investor postures, IBD has uptrend under pressure with an accumulation distribution pattern, D+ on both the S&P and NASDAQ. GMI has an outright sell signal with a score of 1 out of 6. This is a new addition. The stock chart status is what they call the decision point scoreboards. And you see here, not very pretty. I mean, there's a lot of red here, and certainly more neutral settings. Only a few greens, basically the S&P and the intermediate and long term on both the 100 and the NASDAQ showing up arrows, but a lot of warning signs for certain coming in this. So we'll talk more about that in the days to come. In terms of the intermediate term market posture, very bearish. That's the primary time frame that we do most of our trading, our active trading off of. Portfolio and position sizing opinions, you have up to 50% on the one opinion. From the VIX-based one, you have up to 75% on that opinion. So those have also fallen off. The intermediate term market posture, very bearish, and you see the S&P is at the threshold of going to severely bearish if it drops below a 20, and that could very well happen today. Dow is already severely bearish, NASDAQ very bearish, Russell very bearish. There's not much pretty there if you're a bull. In terms of the hedge warning status, we are currently at a level 2, which is what we call the red lights. And there's a lot of reasons you've already seen for that, but more coming. You certainly have, from the volatility base, you have market in decline and sharp increase warning. You have from the VIX spike, we had a spike, and it actually fired a long market signal. So that was expecting that we would have a decrease in volatility in the days after that spike. Now, obviously, it did come down Thursday and Friday, but with today and this week, it could certainly spike back up and fire a new spike. That VIX squeeze did fire long, which certainly portends for more volatility. Distribution day count on the S&P is 7, NASDAQ at 5. VIX phase is climbing, so that's a warning as well. You have this market posture, of course, is below a 50 and in danger of going to below a 20. Look at the New York Stock Exchange new high, new low index, 349. We've had a lot of days lately where this has been well over 300 every single day, so that is not a very healthy sign as well. Intermarket risk aversion indicators, all 5 are flagging as risk off. In terms of specific opinions, our option income strategies, actually the VIX is back inside the acceptable window. So conditions would be acceptable for new positions, but obviously you got to consider the potential for increasing volatility. One thing to keep in mind is when volatility is high, you can take a smaller position size and have the same impact, depending on how you structure your trade. Also, I would mention about this opinion is that the VIX may very well open up, up 15 or 20%, and may no longer be inside the acceptable window. So if you see the VIX outside of 18, higher than 18, then certainly novice traders should probably not be initiating new option income strategies. Cover call strategies, you have novice traders should not initiate new positions. Aggressive traders should use a one-to-one distribution between in the money and out of the money strikes is the opinion there. And then on put selling, conditions not acceptable for new core put portfolio positions. Aggressive traders should consider put credit spreads with defined risk or consider scaling into positions until the market has a confirmed bullish posture, which does not seem to be imminent by any means. In terms of the relative rotation graph, we can continue to see a lot of ugliness here. Look at these long tails all coming down. Now some of these, did kind of hook around, but they've not really started to move in that direction of bottom left to top right, which is what we look for in terms of a healthy movement. Only KRE, which is the regional banking, has been doing well in this environment. And that actually, not to say that this is a sign of that the bull market is done and that we have topped and rolling over, but one of the things to keep in mind as you sense that the bull market is coming to an end is that markets, individual components that do well, start to become more and more selective. So instead of virtually everything being bullish and the most novice trader thinking that they're a hero because everything they buy goes up, it starts to become much more selective in the later parts of a bull market. And certainly I think you could make a statement that we've seen that in recent weeks to months, that what has done well and what has been consistent has been increasingly selective. And certainly that is a sign of a topping pattern and for a major top potentially. From the market postures, you see the only thing that actually is green across all 3 time frames as of Thursday was consumer discretionary. And we've basically seen consumer discretionary and healthcare in recent weeks be really the only 2 sectors that have, if you're going to have all 3 greens, it was usually them. And if things started to get weaker, they were the ones that seemed to hold on a little longer than some of the other sectors. And certainly on the flip side, transportation, telecom, Energy's just been pummeled for a long time. Materials, some of these other sectors that have been very quick to go all red. The other thing, of course, we keep a look at for perspective is this sector percent change, and not just what did it do yesterday, but what has it done the last week, the last month, 3 months, year to date. And you just see a lot of red here, and really no sector has held up as doing well over multiple time frames. So very concerning there as well. So that's probably enough for today. We're about 15 minutes in. Certainly, if you found us on YouTube, greatly appreciate you liking us on YouTube. If you found us on Twitter or Stock Twits, that you'd retweet us and so forth with your favored social media platform. Greatly appreciate that. If you have comments or other feedback, support at falconglobaltraders.com is the place to send us that feedback. More information about what we do is available at this website. Performance matters, we get that. Very transparent with how we model our trades. Disclaimers as always. Hit the pause button if you need more time to review this. And we'll see you back here tomorrow morning before the market opens with the Falcon Global Market Preview. Good trading.